So today I am going to apply Warren Buffett's exact falling knife framework to KPIT Tech and find out if the 16% crash is the end of the road or the ultimate contra investing opportunity. And by the way, Warren Buffett made a contra bet in the late 60s and had made huge gains. In 1963, American Express crashed over 40% when a con man used fake salad oil to trap the company in a $150 million fraud. The Wall Street was convinced that Amex is finished. But Warren Buffett walked into restaurants and banks and saw people happily swiping their Amex cards. He realized that the trust in the brand was untouched. So he bet a massive 40% of his entire fund on this one falling stock. And in just 2.5 years, the stock soared 124%, becoming one of the greatest contra bets in history. So let us use Warren Buffett's contra bet approach and look at KPIT. KPIT Technologies is crashing like a falling knife. But before you panic sell, you need to hear what Warren Buffett said about catching a falling knife.
If either of you were looking at a newspaper stock today, some people may categorize falling knives, what would you use to determine, or how would you determine?
See, years ago when paper stocks were crashing, someone asked Warren Buffett, is it a trap or an opportunity? And Warren Buffett replied, don't look at the stock first, look at the sector and the earnings. Is it a rising sector or a setting sector? Find that out first. But first, let us understand why KPIT is bleeding. See, on July 1st, 2026, KPIT crashed 16.5% in a single day, hitting a series of lower circuits. And if you look at the news, it looks like a horror movie.
Q1 FY27 revenue could decline by around 1%.
It's down 42% so far in 2026.
It's broken all of those levels.
BMW, KPIT's biggest client, is cutting its profit margin. Volkswagen is talking about firing 100,000 people and closing the plants. So the European auto market is bleeding, and because KPIT builds the software brains for these cars, they are also taking the hit. And the management, who just 8 weeks ago said that everything is going great and we are seeing massive growth ahead, suddenly did a U-turn. They announced a revenue decline and a massive margin hit for the first half of the year. So the obvious question is KPIT's growth story dead and should you sell and run away? Let's go back to Warren Buffett's framework, where the reporter asked him about paper stocks in the 1960s. And Buffett explained him that in his own office they are switching from papers to computers. So paper is definitely a setting sector and you never bet on a setting sector. But what about KPIT? To answer that, you have to understand what KPIT actually does. They don't make petrol car engines or doors. They write the code. See, modern cars are basically computers on wheels, and they need software for autonomous driving, battery management, ADAS and connected platforms. And KPIT Tech helps global auto giants build this software. See, the shift from mechanical cars to software-defined vehicles is not a fad. It is irreversible. And even if the EV sales slow down today, every single car maker in the world, whether hybrid, electric or petrol, is desperately trying to put more software into their cars. And they cannot afford to stop these programs completely, because if they do, they will become irrelevant in 3 years. So KPIT Tech is definitely not in a setting sector. It is in a rapidly rising sector. Now coming to Buffett's second rule for a falling knife is to look at the management. Have they walked the talk? Have they delivered in the past? See, before this recent warning, KPIT's management had delivered an incredible 23 consecutive quarters of consistent growth. They have a proven track record of execution. But yes, the current pain is real. The European EV market is facing a brutal reality check because of Chinese competition and price wars. But this slowdown is entirely driven by external geopolitical tension and European macro weakness. So it is a delay, not a cancellation. And the management expects a return to sequential growth by the fourth quarter of FY 2027. So 1 or 2 bad quarters do not erase 23 quarters of excellence. Now here is something which most of the people missed in the panic. The scary headline was about a 1% drop in the USD reported revenue. But because the Indian rupee has depreciated by 5% in the past year in rupee terms, KPIT's revenue is actually flat to marginally higher. So the collapse in the stock price was far more brutal than the collapse in the actual business. So now let's talk about the third thing which Warren Buffett says. What price multiple or what PE are you ready to pay for the business? So now let's talk about the valuation. Now at its peak, KPIT was trading at an insane PE of 70 to 80. It was priced for absolute perfection. And the moment the growth slowed down, that premium collapsed. And the stock has now corrected nearly 70% from its 52-week high. The price to perfection risk is gone now and the expectations have finally come back to realistic levels. See, fundamentals alone are not enough. If you buy only on fundamentals, then you will buy a great stock but at the wrong time. See, there are phases where the fundamentals are improving but the stock price is still down. These are the undervalued phases and this is exactly where you build your position. Now look at KPIT. The stock is down almost 70% and when it was running from 1200 to 2000, everyone wanted to buy it. But now it is available at 500 rupees and nobody is interested. But that is exactly why I am interested. Now here is the key level. In 2022, KPIT crashed more than 50% and took support near 508 rupees. And today, the stock is back at the same support. And high chances are that the stock takes support here and reverses. And this is where I go aggressive. And the valuation is also looking attractive at a cheap PE of just 23. And I don't think we will get a chance to buy this stock at this level again anytime soon. So let's summarize the contra bet using Warren Buffett's lens. The sector is rising, the management has a stellar long-term track record, the balance sheet is clean, and the current problems are cyclical, not structural. And the next 2 quarters are going to be ugly and the stock still needs to go through a time correction to shake out the weak hands. But as an investor, you don't buy a great company when everything is looking perfect and the stock is trading near all-time high. You buy when the news is terrible, but the core long-term thesis still remains completely intact. And I still view KPIT as a strong SIP grade company. You just need the stomach to handle the near-term volatility. So this was Sanika from RangaOne Finance and I hope you like my analysis. And don't forget to like, share and hype this video. And I will see you very soon in the next one. Till then, bye-bye.
Investment in the securities market is subject to market risks. Read all the related documents carefully before investing.